Hi, and thanks for joining us today. I'm Steve Blumenthal, and joining me is Brian Sanborn from Ned Davis Research. Brian, how are you?
Good, Steve. How you doing?
Good. Hey, listen, so I see that big New York Yankees sign in the back there. We're going to have a lot of very happy people. We're going to have a lot of very unhappy people that are having to watch this today.
Well, in my defense, I'm originally from New York, but I guess just like investing, I like to follow a long-term trend, and I think the Yankees have been a solid bet longer term.
Yeah. Well, that's same with my kids. Their first team, one was the Pittsburgh Pirates. I'm a crazy Phillies fan, being from Philadelphia and family from Philadelphia for years. And in the little peewee baseball, when my kids were young, one was a Pittsburgh Pirate fan, and he's still crazy. I can't get him to the Phillies, and the other guy's a Yankees fan. So
Good decision.
it's in the house. So the trend has been a good one. We all like a winner. I would like to see my Phillies do a little bit better. So we're here today to talk about the Ned Davis Research Dynamic Allocation Strategy. For those of you that aren't familiar with Ned Davis is a renowned legend in the investment business. One of my favorite all-time books is Ned's book, Being Right or Making Money. I've been a client to the research service since the mid-90s, and I remember reading that book some years ago. Further, we've done a lot of work with your firm. We partnered on a long flat strategy that we've created together that's doing quite well through some of the challenges that we're dealing with in 2020. So Brian, tell us a little bit about you. I know that you're Senior Vice President of the Wealth Management Solutions. We already discussed the Yankees, so let's move past that. And how long have you been with Ned Davis Research? And then I'd like you to tell us a little bit about Ned Davis and then walk us through the strategy.
Sure. So my background is quantitative in nature. So I've been with NDR since 2004. At the time, they were building out a research and development team to start to build out more modeling techniques as well as new strategies. So I was hired to help with that effort. But over time, I've helped build out other products for them, including their global stock selection service, which uses the NDR approach, which we'll talk about in a moment. But the opportunity to then grow into this role that I'm currently in, which is Senior Vice President of Wealth Management Solutions. What we've seen in the industry has been a growing demand for direct delivery of our models and signals for investment. And so I've worked with a number of partners to deliver these NDR models to them so they can host them either through separately managed accounts or even through, as you talked about before, on the ETF side, through ETF issuers.
Great, got it. Well, that's how we face you. We have you up on our turnkey asset management platform as a strategy available for somebody to grab off the shelf and put into a portfolio.
Absolutely, and I think it really does speak to the evolution of NDR. So NDR, we've been around since 1980, and historically our premise has been to produce independent investment research that we sell through investment subscriptions to our clients. And when Ned was building out this service, he wanted to ensure that the approach followed his philosophy, which was avoid subjective commentary, to have a foundation in the objective weight of the evidence. And so whether it be an asset allocation call or a sector call, we always want to have indicators and models to help us with those calls. And so over time, for the past 40 years, we've been building out this library of tens of thousands of charts, which reflect macro indicators, fundamental indicators, technical indicators, and behavioral indicators that we then combine to produce our investment recommendations. And now we have that ability to partner with firms like yourself to give our clients direct access to those strategies.
Well, we're thrilled. So my staff and my kids will beat me up, but I have a sticky that I keep on my desk of certain quotes that I find that are relevant. And this is a Ned Davis quote: listen to the cold, bloodless verdict of the market. That's what price-based indicators accomplish. So I keep that one close. I know it's the core of everything you do. Walk us through the strategy.
And if you don't mind, I'm actually might share my screen here just to show you what this looks like. And in terms of the strategy itself, let's actually jump right into the thick of it, which is when we were building this particular asset allocation strategy, which allocates between stocks versus bonds versus cash, we wanted a strategy that was going to take a high conviction approach to asset allocation. And in particular, one of the things that we focused on was to help avoid those big losses that can really, of course, from a portfolio perspective, damage the long-term ability to grow assets over time. But also, there's a behavioral aspect to this as well, that studies have shown that if you take a loss on something, usually you basically need double the gain to offset that feeling you get when you lose $1. And so we really want to focus on that particular aspect of asset allocation to help our clients navigate sometimes some very difficult environments. And the way we've approached this particular concept is threefold. One is the ability to take large cash positions when things are just very volatile, markets are in turmoil, and you start to see a lot of the data line up that we're in for a rough patch. The safe haven to go to is cash and wait for a better opportunity to enter. The other thing, and I mentioned this before, is the behavioral side of investing. By subjectively making decisions, you do open yourself up to maybe you make one decision correct where you time getting out of the markets correctly, but sometimes the hardest part is then getting back in because you wait for that perfect moment and it might pass you by where you're sitting on the sidelines for years to come with cash holdings and not participating in potential up move. And so that's why this strategy is purely systematic. It takes out that human element where you avoid those behavioral mistakes that, again, we're all prone to. It's just human nature. And then finally, at NDR, we have our 9 rules of investing, and one of the main rules is not to fight trend. And so within this particular strategy, we want to pick those instruments, those ETFs, that have the strongest relative strength within a particular asset class. And so by latching on to those long-term trends, that's how you can make the most money. And so that's what Ned has really preached to us is don't fight the trend.
Agreed.
So just
move forward for us on the next slide.
Yeah, so just to be a little bit more specific about it, so I've given you a high-level overview of what the strategy is, but there are 3 parts to this particular strategy. The first is the asset allocation decision. How much asset allocation or allocation should you put into stocks versus bonds? And the NDR approach is to combine the broad economy and what's going on in the economy. Are the economic indicators improving? So, for example, is unemployment falling? Is global growth improving? So that's one area. That gives you the backdrop for the environment. And of course, from risk management, from a timing perspective, then you want to leverage the relative strength of stocks versus bonds. In other words, how are stocks performing versus bonds? Are they in an uptrend or a downtrend? And another aspect of the technicals of the price action is looking at participation globally. So in other words, how many markets globally are in uptrends? And if you don't see many markets in uptrends globally, but the prices are still going up, that could indicate that the equity markets are susceptible to a larger drawdown. Because if one of the markets that is in uptrends starts to roll over, there's nothing else to support that trend. So you want to see a number of markets participating on the upside. So we're leveraging both the price-based indicators as well as those macro fundamental indicators. A couple of other examples. One of those other 9 rules of research that we follow at NDR, I'm probably going to expand on this a little bit, but historically we've said, don't fight the Fed. The Fed is the Federal Reserve in the United States. But as we become more global, it really is don't fight the global central banks. So we're looking at not only the Federal Reserve, but we're looking at the Bank of England, the ECB, as well as the Bank of Japan. And so we have an indicator that looks at how these central banks are. Are they easing or are they tightening? Because that absolutely has an impact on that stock bond decision. And so to make that final call here, what we want to see, if you want to favor, if the model is going to favor stocks, you would likely see that global stocks are in uptrend versus bonds. You'd likely see that global stock markets are in uptrends as well on a broad basis. You would see that economic indicators such as unemployment's falling, global GDP is growing. The Baltic Dry Index measures shipping rates globally. You'd like to see improving shipping rates, indicating that activity is flowing across the world. The Purchasing Managers Index surveys different manufacturing industries. So you'd like to see an optimistic outlook for manufacturing. And of course, central banks, again, you want to see central banks that are friendly to equity markets. And of course, conversely, when those things are the opposite, that's when you want to be into fixed income and cash, because that likely would indicate that the global economy is in a slowdown, that the markets recognize that, and stock markets are also in downtrends.
Good, helpful.
And then lastly, very briefly, once you make that stock bond decision, of course, then you need to allocate within both stocks as well as within bonds. And that's when we leverage the relative strength within an asset class to find where the best performers are within each of those areas. And you can see the diversity of the assets here.
So you utilize ETFs to express that view. So if it's in dividend or technology, small cap or large cap, you would utilize an ETF that gets that exposure. And these are all ETFs that are highly liquid, easily tradable. Want to touch on that real fast?
Absolutely. So the way we built this particular strategy was to be ETF agnostic. We actually use the underlying indices to build the strategy. But of course, once you go to implement, you need to have those tickers or those ETFs to invest. Our index committee works with our ETF strategist to find the largest, most liquid ETFs. So we look at things like the market cap, we look at expense ratios, we look at volume, and we don't change the ETFs very often that represent each of those indices. So in this case, we are fund family agnostic. In fact, we actually pull ETFs from various fund families, again, to find the cheapest, most liquid options for each of these areas.
Well, our CMG team Malden advisor will help our clients understand a deeper dive, more specifically. Once a month, you put out a great piece that gives a summary of positioning. That's quite helpful. That's something that we're able to utilize and update our clients with. So we keep that great work up. We appreciate it. Anything else that you can think of that you'd like to add?
I think just a couple of things to recap. Remember that this is a purely quantitative process. We're taking out the human element from it to avoid those behavioral mistakes. We have a top level stock bond decision, which leverages the weight of the evidence, which is critical. One analogy I always like to give when talking about this approach that uses the macro fundamentals and the technical and behavioral is if you think of your investment process as a tree of branches. If you put all of your weight on one branch and that branch breaks, you're going to fall pretty far to an unfortunate outcome. Whereas if you're spreading your weight across multiple branches, even if one of those branches buckles, you can disperse your weight and still actually survive. And that's really what we're trying to accomplish here by using these different types of indicators. And a couple of other quick points on the model itself. We've had this particular model in our service, our subscription service, the underlying alpha model since 2012. So we've been running this live since then. And then at NDR, we also have a small amount of proprietary assets that have been tracking this strategy since September 1st of 2017. So this is something that it's one of our most popular strategies. And we have a lot of clients who love to follow this particular strategy as evidenced by the flows we've seen into it over time.
Well, for us, we like that it really represents a solid portion of an investor's core because it's all asset and because it's risk managed. So really appreciate you taking the time to be with us today. This is most helpful. Thank you, Brian.
Thanks so much, Steve. Have a great day.
You too.